Stephen Pelayo, who's the Regional Head of Technology Research at the HSBC Securities. And I want to welcome you on this sunny Wednesday here to our studios. It's pretty rare here in Hong Kong for sunshine, so that's why I keep making an issue out of it. Let me just ask you about, I guess, sunshine for the technology sector. You know, we talked about this comeback for emerging market stocks and also for the recovery in chip prices as well. What about 2010?
So you look at the semiconductor cycle where we are right now. We're actually seeing monthly semiconductor revenues at about the prior peak. So I certainly can't tell you we're at the beginning of a semiconductor cycle. That's why you're having people start to talk about, should I have 1 foot closer to the brake here? Should we be a little bit more nervous? I've covered semiconductors for about 15 years or so, and a couple things are different this cycle. From a demand side, don't forget the price elasticities. We're buying flat panel TVs, big ones for under $1,000, smartphones for under $200. Don't forget about the emerging markets. They're driving a lot of the incremental growth that we didn't have back in the tech bubble that was going on. And then I think perhaps most importantly on the supply side of the equation, everybody's nervous about what happened a year and a half ago, how quickly things fell off. Nobody wants to stretch their balance sheets and carry too much excess inventory. So people are trying to keep inventories very controlled. Now, when I fast forward to today, what's going on? Near-term demand patterns look very, very strong. Capacity is very tight. Inventories are quite controlled. Really, the key risks are what's going to happen in the middle of the year, what's going to happen towards the second half of the year as people start to get nervous about capacity being too tight. Do they start to double book? Do we then see inventory build? What about semiconductor capital spending? It's up about 75% this year. People are increasing a lot of capacity to try to alleviate those tight, fully utilized factories right now. Is that going to cause excess capacity, which then starts to cause margin pressures, pricing pressures if we have any excess in there? So that's what I think everybody's nervous about, and that's the key risk for the second half of the year. I think if we are going to be saved, it's going to be, again, the emerging markets being there, a broadening out to more of the developed markets for sure. And then also don't forget we have a whole slew of new products that are coming out this year. Intel's got a big product cycle, certainly flat panel TVs with moves to LED and still more penetration coming on in TVs. Smartphones are of course very, very strong as well.
PCs, you can't
and
forget
of course Apple's coming out with theirs, and HP and Microsoft, they all have a new tablet. So very strong, a lot of product cycles coming up this year.
So what about semiconductor prices then? We did see that come back in 2009. I mean, everything really recovered because of that trough that we saw at the end of 2008. What about for 2010 then? As you said, there's a lot of things at play.
It's really interesting. We bottomed exactly 1 year ago, to put some numbers to it. On a monthly semiconductor revenue basis, we're up about 80%. From that number. So it's been a massive snapback. When I look to 2010, we have semiconductor industry for the full year growing almost 20%, about 18% or so this year, after declining about 9% last year. And once again, it's those key end markets, flat panels, smartphones, handsets, some consumer electronics that are really driving the growth this year.
Yeah. Well, what do you say to those people that invested in the tech bubble? The dot-com bubble 10 years ago, and as you see, we're still 50% from those aspirational levels near 5,000 on the NASDAQ.
Well, I mean, certainly the tech bubble had a confluence of a number of things going on. Certainly the drive to consumer electronics from just the corporate world, the whole internet revolution. We had a lot of things going on, in addition to a little exuberance, if you will. If anything, if you look at semiconductor units, we still ship billions of these things every month. You and I still consume more and more silicon, and it's surrounding us more and more each and every day. So from a unit numbers, if anything, the semiconductor trends continue to point up and to the right from a unit perspective.
Well, let me just ask you and break it down into stocks then, because you're one of the top-ranked analysts around on chips stocks, and we were talking about semiconductor manufacturing in China. Now, if you look on the Bloomberg system and I guess a survey of analysts across the board, only you are calling it a neutral. Everyone else is calling it a sell. So I guess that makes you more optimistic than most.
We got very lucky, very fortunate. Back in October, mid-October, we upgraded the stock to overweight. And we were seeing some signs that said that, look, this is the first time in 10 years this company is going to be free cash flow positive. Looks like their utilization rates are picking up. Their margins may be on the mend as well. And it was trading at 0.5 times book value. And we said, okay, this is worth the risk. And matter of fact, the title of the report at that time was, Are We Crazy? Because there are so many people that had sell ratings on it. Now, obviously, we got very lucky. The stock ran about 80–85% or so in the last 3–4 months. We just downgraded it about a month ago, February 10th or so, and simply saying now at 1.2 times book value, still unprofitable this year, looking actually unprofitable next year, making progress but still unprofitable.
Shorting opportunity.
There are better relative ideas. And so as you mentioned earlier on, I'm focusing on stocks that are relatively cheaper that still have margin expansion left into them.